Hey, welcome back to Compounding Quietly. The higher the income, the better the ETF. That is what most investors assume the moment they put JEPQ and QQQI side by side. But yield is not the score. It is the price tag. Let's look at what is actually being sold to produce it. Both JEPQ and QQQI run on the same underlying idea. Take Nasdaq 100 exposure. Sell covered calls on top of it. Collect the premium. Distribute it as monthly income. That description sounds clean, but the moment you ask what kind of covered calls and under what structure, the two products start to look very different. Most investors who compare these two ETFs start with yield. QQQI has delivered annualized distributions somewhere in the range of 15 to 20%, depending on market conditions. JEPQ has typically distributed somewhere closer to 9 to 11%. The gap is not small. If your first reaction was, why would I ever choose the lower yield? That is a reasonable question. And it is exactly the question worth slowing down on. Because the yield number does not tell you what was sold to produce it. It tells you how much income was delivered. Those are two different pieces of information. Imagine an investor in the early phase of building income. They have been watching both of these ETFs for several months. They know the general strategy. They understand the structure. And one day, they decide they are ready to commit. They look at the yield comparison one last time and pick the higher number. That choice feels rational because they are measuring the right thing. In the wrong direction. They measured the output. They did not ask about the input. A covered call strategy generates income by selling someone else the right to buy your shares at a fixed price. You collect a premium immediately, but if the underlying index rises above that price, you do not participate in the gain above it. That upside has been sold. It belongs to the buyer of the option, not to you. This is not a flaw in the strategy. It is the strategy. Every investor in a covered call ETF is making this trade, whether they understand it clearly or not. The only question is, how much of that trade and under what terms? JEPQ is managed by JP Morgan Asset Management. It implements its covered call exposure through equity-linked notes, structured instruments that simulate selling options. Without holding them directly, the overlay is partial. On average, somewhere between 20 and 30% of the portfolio is covered at any given time. That means the large majority of the Nasdaq 100 exposure remains open to upside participation. When the index rises sharply, JEPQ captures most of that move. The income yield is lower as a result, but total return income plus price appreciation has the structural room to stay competitive in strong market years. QQQI is managed by Neos Investments. It sells options directly on the Nasdaq 100 index, using a rules-based approach designed to maximize income. The coverage is significantly more aggressive. More of the portfolio's upside is sold at any given time. When the market moves higher, QQQI captures less of that appreciation because less of it was available to begin with. The income is higher because more upside was offered for sale. That is the exact mechanism, not a bonus layered on top of the same structure. An exchange of a different magnitude. Here is where that exchange becomes visible in real market conditions. Think about a year when the Nasdaq 100 rises 40 to 50%, which is not a hypothetical for recent history. An investor in JEPQ collects income throughout the year, but the fund's net asset value also appreciates meaningfully because the majority of the upside was retained. When you add income and price movement together, total return has been competitive in those years. An investor in QQQI also collects distributions at a higher rate, but price appreciation is more constrained because more upside was sold in advance. Add income and price movement together, and the total return gap between these two products in a strong rally year can be meaningful. Now consider the opposite environment. The Nasdaq 100 moves sideways for a full year. Moderate volatility. No sustained trend in either direction. In that environment, both funds collect premium income throughout the year. The upside that was sold never gets reached, so nothing was lost to the option buyer. The income arrives in full, and the investor in QQQI earns more while giving up nothing visible. In a flat or declining market, the yield advantage carries no obvious cost. This is why the question is not which product is better. It is which environment you expect, and, more honestly, which position you are in right now. A covered call ETF built on the Nasdaq 100 is not a conservative instrument. It carries the underlying volatility of the index it sits on. The income cushions some of that volatility, but it does not eliminate it. Coming back to the original question, JEPQ versus QQQI is not a quality comparison. It is a position comparison. Where are you in your investment life? And what does your portfolio actually need from this allocation? Those two questions narrow the comparison faster than any yield chart. If you are in the distribution phase, drawing from your portfolio to cover regular expenses, the yield gap has real and immediate weight. A meaningfully higher monthly distribution from QQQI may reduce how much you need to sell from other positions each month. The upside you are giving up may feel abstract compared to the income that arrives on schedule. That is a legitimate exchange if you understand it clearly before you make it. If you are still accumulating, building toward a future income target, the upside gap compounds in ways that are easy to underestimate. Giving up a significant portion of Nasdaq 100 upside annually, compounded over a decade or more, changes the shape of total wealth. You may arrive at the distribution phase with consistent income history and a smaller overall portfolio than you intended to build. That is the cost of selling more upside than your timeline requires. There is one more variable worth placing in your criteria before you decide. QQQI writes options on a broad index, and in some jurisdictions, index options receive a different tax classification. That treatment can create a more favorable after-tax outcome for certain investors in high-tax environments. JEPQ's equity-linked note structure typically produces distributions that are treated as ordinary income. Tax treatment varies by jurisdiction and individual situation. But if after-tax income is your real number, not headline yield, this variable belongs in the comparison, not as an afterthought. Neither of these funds is a poorly designed product. Both are transparent about what they are. Covered call income strategies built on top of a high volatility growth index. What they require from you is an equally honest answer about what you are using them for. The product is not the variable. You are. If you need current income and you accept that upside participation is the cost, QQQI is a coherent choice. If you want income alongside retained growth potential and you accept a lower monthly yield for that balance, JEPQ is a coherent choice. The trap is stopping at the yield comparison and treating the higher number as the conclusion. Yield is the result of the trade. Understanding the trade is the judgment. Covered call income is not a bonus. It is sold upside, returned as cash. What you gave up matters more than what arrived. That is the criteria that holds when the market shifts. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.